Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about health savings account. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribed. I will try to personally reply to your comments. Let's get into the video. The health saving account is one of the most misunderstood and underused benefits in the Internal Revenue Code. Congress created HSA as a way for individuals with high deductible health plans to save for medical expenses that are not covered by insurance due to the high deductible provisions of their insurance coverage. HSA as a retirement vehicle. Although the tax code refers to these plans as health saving account, an HSA can act as more than just a vehicle to pay medical expenses. It can also serve as a retirement account. For some taxpayers who have maxed out their retirement plan options, an, an HSA provides another resource for retirement savings, one that isn't limited by income restrictions in the way that an IRA contributions are. Since there is no requirement that the funds be used to pay medical expenses, a taxpayer can pay medical expenses with other funds, allowing the HSA to grow through account earnings and further tax deductible contributions until retirement. In addition, should the need arise, the taxpayer can still take tax-free distributions from the HSA to pay medical expenses. Unlike traditional IRAs, no minimum distributions are required from the HSAs at any specific age. Withdrawals from an HSA that ain't used for medical expenses are taxable and subject to a 20% penalty, with one exception. An individual age 65 or older will pay income tax on non-medical related distributions from the HSA, but won't owe a penalty for using the funds for other than medical expenses. Let's take an example. Henry, who is age 70, has an HSA account from which he withdraws $10,000 during the year. He also has unreimbursed medical expenses of $4,000. Of his $10,000 withdrawal, $6,000, which is 10,000 minus the 4,000, is added to Henry's income for the year, and the other 4,000 is both taxed and penalty free. If Henry had been 64 years old or younger, he would be taxed on the 6,000 and pay a penalty of $1,200, which is 20% of the $6,000. Eligible individual. To be eligible for an HSA in a given month, an individual, one, must be covered under a high deductible health plan on the first day of the month. Two, must not also be covered by any other health plan, although there are some exceptions. 3. Must not be entitled to medical benefits, that is, generally must be younger than age 65. And 4. Must not be claimed as a dependent on someone else tax return. Any eligible individual, whether employed, unemployed, or self-employed, can contribute to an HSA. Unlike with an IRA, there is no requirement that the individual have compensation, and there are no phase-out rules for high-income taxpayers. If an HSA is established by an employer, then the employee and or the employer can contribute. Not just family members, but any other person can make contributions to HSAs on behalf of eligible individuals. Both employer contributions and employee contributions made via the employer's cafeteria plan are excluded from the employee's gross income. Employees who make HSA contribution outside of the employer's arrangements are eligible to take the above-the-line deductions. That is, they do not need to itemize deductions for those contributions. The monetary qualification for an high deductible health plan. The minimum annual deductible coverage for 2020 for self only is $1,400. For family is $2,800. For 2021, self only is $1,400 and family is $2,800. So basically, the minimum annual deductible coverage for 2020 would for self only is $1,400 and for family is $2,800. For 2021, for self it's $1,400 again, and the same as family is also $2,800 for 2021, the same as it was in 2020. The maximum annual out-of-pocket expenses for 2020 for self only is $6,900 and family is $13,800. For 2021, self only is $7,000 and family is $14,000. Let's look at an example. Family plan does not qualify. So let's look at Joe. He has purchased a medical insurance plan for himself and his family. The plan pays covered medical expenses for any member of Joe's family if that family member has incurred covered medical expenses of over $1,000 during the year. Even if the family as a whole has not incurred medical expenses of over $2,800 during that year, first, if Joe medical expenses are $1,500 during the year, the plan would pay $500. This plan does not qualify as a high deductible health plan because it provides family coverage with an annual deductible of less than $2,800. Another example, the family plan qualifies if the coverage for Joe and his family from the example above included a $5,000 family deductible and provided payments for covered medical expenses only if any member of Joe's family incurred over $2,800 of expenses. The plan would then qualify as an high deductible health plan. Maximum contribution amounts. The amounts that can be contributed are determined on a monthly basis and are calculated by dividing the annual amount shown below by 12. First, if an individual health plan only qualify that person for an HSA for 6 months out of the year, then that person's contribution amount would be half of the amount shown. Maximum annual contribution year 2020 self only is $3,550, which is $3,550. and family is 7,100. For 2021, self only is 3,600 and family is 7,200. In addition to the amount shown, an eligible individual who is age 55 or older can contribute an additional 1,000 per year. How HSAs are established. An eligible individual can establish one or more HSA via a qualified HSA trustee or custodian, an insurance company, bank, or similar financial institution. In much the same way that an individual would establish an IRA, no permission or authorization from the IRS is required. The individual also is not required to have earned income. If employed, any eligible individual can establish an HSA with or without the employer's involvement. Joint HSAs between a husband and wife are not allowed. However, each spouse must have a separate HSA and only if eligible. Qualified medical expenses. To be non-taxable and penalty-free, distributions must be for unreimbursed expenses paid by the HSA account owner, their spouse or dependents for medical expenses that have the same definition as medical expenses for purposes of the medical itemized deduction. Amounts paid for medical or drugs are qualified medical expenses for HSA distribution purposes only if the medicine or drug is prescribed, determined without regard to whether such a drug is available without a prescription or insulin. The qualified medical expenses must be incurred only after the HSA has been established, and medical expenses paid or reimbursed by HSA distributions cannot be claimed as medical expenses for itemized deduction purposes. Generally, health insurance premiums are not qualified medical expenses for HSA purposes, except for the following: qualified long-term care insurance, but only up to the amount of the annual age-based limit that applies for deducting long-term care premium as medical expenses. COBRA Healthcare Continuation Coverage. Healthcare coverage while receiving unemployment compensation and for individuals aged 65 or over, premium for Medicare A, B, or D. Medicare HMO and the employee share of premiums for employer-sponsored health insurance, including premiums for employer-sponsored retiree health insurance, but not Medicap policies. Menstrual products. Effective for tax year 2020 and later, the CARES Act added a provision that permits tax-free reimbursement from health saving accounts for cost of menstrual products. Telehealth. The rule has been that taxpayers may only make contributions to HSAs while they are covered by a high deductible health plan. However, the CARES Act allows a high deductible health plan to provide telehealth and remote care services without a deductible for 2020 and 2021. So generally, the health saving account is another great investment account you can use to invest your money. Thanks for watching this video. and do not forget to subscribe to my channel.